Hey guys, I hope you all are doing great. So, welcome to the next episode of the Audit Practically series. So, today we are going to be looking at a very common question that's asked in any finance interview that you attend. And the question is negative working capital good or bad for a business? Guys, so if I have to give you a one word or a one line answer, I'll just say it depends. It depends on a variety of factors. So, today we're going to be first looking at the factors that are going to be determining whether negative working capital is even good or bad in the first place. Next, let's say you're the auditor of a company that has negative working capital. How do you perceive this as a start auditor of that company? That's what we're going to be looking at next. After that, finally, we're going to be looking at how you're going to be structuring this answer when the interviewer puts forth this question to you. So let's say the interviewer asks you, is negative working capital good or bad? So how do you structure an answer to this question? How do you impress the interviewer in one go? So we are going to be covering these three aspects in today's video. So sit back, relax, and enjoy as we deep dive and dissect this, right? So on to the video, guys. So basically, what is working capital? So working capital is basically the capital that is required to meet our daily business requirements. So if I have to give you a formula for it, it is basically my current assets minus current liabilities. So basically, negative working capital refers to a scenario where my current liabilities are greater than my current assets. Obvious, right? I hope you understood this. So basically, this is the scenario which we are going to be discussing about today. So right now, let's take two balance sheets. So both these are balance sheets of a manufacturing company. So let's look at the first balance sheet now. So let's say there is share capital of rupees 10, current liabilities to the extent of 20. So CL is basically current liabilities, CA current assets to the extent of 15 on my asset side, then my fixed assets, property, plant and equipment, that is FA, to the extent of 15. So both the sides are matching, obvious. So basically, if you look at this here, guys, my share capital is a long-term source of finance. Am I right? Yes, sir. My current liabilities are a short-term source of finance, and my current assets are short-term applications of funds, and my fixed assets are long-term applications of funds. Obvious, right? Yes, sir. So what would happen here is my fixed assets of 15 would be financed from my share capital to the extent of 10. But there is a 5 of financing that is further required for fixed assets, right? Where would this come from? To simply put it, this would come from current liabilities, because my current liabilities of 20 would fund my current assets of 15 first. Then there would be a surplus of 5 that would be left in my current liabilities, which would be used to fund my fixed assets, right? So is this scenario good or bad? Just put this in your mind for now. Think of the answer, and in the meanwhile, we'll go to the second scenario and we'll discuss both these scenarios together. Okay, again, this is a balance sheet of a manufacturing company, let's say, which caters to the B2B segment. B2B meaning, let's say you're a business and your ultimate customer is also a business. It's not the general public. Like for example, you take a company like Spencer's, the ultimate consumer in most of the cases is common public like you and me, right? But we are talking about a scenario where the ultimate consumer of this company is again a business. I hope you understood this. So next, let's take another balance sheet of a manufacturing company again, which is in the B2B segment. Let's say the share capital is 10. Let's say the current liabilities are 20. So what would happen is, again, my current assets, let's say, are 15, fixed assets are 10, and let's say I have an FD which is long term in nature. Let's say the FD is maybe for 24 months. Let's say it's long term in nature. So let's say that is amounting to 5. Again, the total of both the sides are 30, which is again tying out. So what would happen in this case? So my current assets of 15 would be funded by current liabilities first. So I have a current liability of 20, I have a current asset of 15. So I would fund my current assets to the extent of 15 from my current liabilities. After which I will have a surplus of 5 in my current liabilities, right? So I will use that for my long-term funding. So for example, if you see here, I have a share capital of 10 and a fixed asset of 10. So my fixed assets would be funded from my share capital to the extent of 10. So my FD, which is non-current in nature, of 5 would be financed from my surplus of 5, which is sitting in the current liability. So ultimately, if I have to just give you a recap, my share capital of 10 would be entirely used to finance my fixed assets of 10. My current liabilities of 20 to the extent of 15 would help in financing my current assets, and the differential of 5 would help in financing my non-current fixed deposit, which is there for 24 months. Okay, so you would have a question now, whether is this good or bad? Some of you might right away come to a conclusion and say, sir, both A and B are bad, sir. Why? Because my short-term funds are getting used for long-term purposes. Because some of you would have watched the fund flow video which I uploaded, and you would come to a conclusion saying, sir, we are using our short-term funds for long-term purposes and this is not a good business practice. Yes, my dear friend, I definitely agree with you. But let's even deep dive into it more. Like for those of you who've seen my fund flow video, you would be able to relate with what I'm saying now. If you have not checked that video, you can click the I button above and check that video. And I've also attached the link of that video in the description. So you can check that out first and come to this video. You would have an even better clarity. So to even deep dive further and explain why this is an issue or not an issue, let's just come down a bit, right? Okay, so in case A and case B, you need to get an understanding of why there's a negative working capital. So let's say, why do you have a negative working capital here? Like for example, if we come here, my current liabilities are 20, my current assets are 15. So my current assets minus current liabilities, 15 minus 20 is minus 5. We have a negative working capital here. Again, let's come here. You have a current asset of 15, a current liability of 20, 15 minus 20 again is a minus 5, which is negative working capital. So you need to understand, like, this 20 would usually be your trade payables, and your 15 of current assets would usually be your inventory and your trade receivables, right? So you need to get an understanding of why your current liabilities are more than your current assets. Let's say it is due to a scenario where the entity is delaying payment to creditors. What do I mean by delaying payment to creditors, sir? Let's say the credit period that is agreed between the entity and its supplier is 15 days. So ideally what should happen, on the 15th day, the entity should be paying its supplier, right? But let's say that is not happening. Let's say the entity is delaying the payment to the supplier. Let's say the entity is not paying the amount on the 15th day. Then it's genuinely a matter of concern, guys. You need to assess whether there is a need to assess going concern ability. You need to assess whether there exists a material uncertainty related to going concern. So as an auditor of the company, you need to assess this in accordance with SA 570. So I have again made a video on my channel in the form of a YouTube short where I've explained how you need to assess this scenario, in the sense, like, what paragraph would you give, what opinion would you give in which scenario in relation to SA 570. Again, I am attaching that video in the description. You can click that out and check it. It's only a 2 minutes YouTube short, and after you check that out, you would be able to relate to what I'm saying right now, right? Next, let's say it is due to good collection ability. Let's say I as an entity, I am having good collection ability. Let's say my receivables team are really competent. They're able to collect the amounts from my customers even before they are due. Then it's something I need to be happy about. And let's say I follow something like a just-in-time inventory, where I'm able to predict my demand, where I'm able to forecast my demand, due to which my inventory holding is getting reduced. So this is something to be happy about. Yes, sir, definitely. So in this scenario, let's take the case A again. So if you see case A, what is happening is, my fixed assets to the extent of rupees 5 are getting financed from my current liabilities, right? Yes, sir. So this is a matter of concern to an extent. Why, sir? Because let's say my creditors to the extent of 5 come up to me tomorrow. What would happen? I do not have corresponding current assets because my current assets are only 15 while my current liabilities are 20. It might lead to a scenario where I might need to sell my fixed assets to pay my current liabilities, right? But is that always the case? No, sir. If we just come here, so that's what I've said. In case A, you need to understand if the fixed assets of 15 contain major fixed assets that help in production, creating ability to generate cash flows. Let's say this fixed assets of 15 contains equipment that assists directly in the production process. Or let's say the fixed assets of 15 contain assets that help in producing a product that has a good demand in the market. In such a scenario, you would not need to sell your fixed assets to pay off your creditors. Since your fixed assets are assisting you in your production process, what would happen is you would have good produce, you would have inventory arising out of production, which you would be able to sell in the market and meet your current liabilities. So then you would not be having any concerns. But you need to check if the entity has open orders against this. Let's say the entity has, out of this fixed assets of 15, let's say the entire 15 of fixed assets relates to production of a good or a product that has very good demand in the market. Should you be concerned? No, not really. Let's say you have an open demand. Let's say you have open sale orders. Like, let's say you have commitments to your customers that you need to supply goods to the extent of so and so amount in the future, and that is able to cover your current liabilities. It is not a matter of concern. But let's say you just have fixed assets that have good production capabilities, but you don't have any open sale orders against it. Then it is a matter of concern, guys, because the company wouldn't be able to sell any produce out of the fixed assets that are arising. Like, what would happen is the fixed assets would yield some produce, would yield some products, but since you don't have any open sale orders, you would not be able to liquidate the inventory that is produced with the fixed assets. Then it is a matter of concern, and again you would need to assess the going concern of the entity, right? Next, let's take case B. Okay, coming to case B, let's again go up to the balance sheet of the company. If you see here, my fixed assets of 10 were entirely financed through a long-term source, which is share capital, which is perfectly fine. Yes. If you look at my FD of 5, it was financed through current liability. My FD again is classified as non-current because it has a maturity of 24 months here. Is this a matter of concern for me? No, sir, not really, because liquidating an FD is easier compared to liquidating a fixed asset. Am I right? Yes, sir. Even though the business has used short-term funds for long-term purpose, this seems like a more strategic decision from the business standpoint, because the business has clearly put it in an FD where they're going to be getting a constant cash flow of interest that is going to get accrued on the FD. So in that sense, if you look at it, this is not really a matter of concern. Even though there is a diversion of funds, this scenario is not really a matter of concern. I hope you understand this, guys. Next, if I just come down below, let's take another scenario. Let's retain the same balance sheets as they are, and let's just tinker it a bit. Let's say this balance sheet is not in relation to a manufacturing company. Let's say this is in relation to a company which caters to B2C. Like, let's take Spencer's. In Spencer's, it's a B2C concern because the ultimate consumers or customers of Spencer's are you and me, right? Because we go to the supermarket, we procure the goods, we pay cash immediately, right? So let's take a business like that, and let's say there is no change in the numbers. Let's come down, right? So let's say the balance sheet in the above example relates to a B2C concern, example Spencer's supermarket, and not a manufacturing concern. So what would happen is, the reason for the negative working capital would be obvious, because what would happen is, Spencer's obviously will purchase the goods on credit from their suppliers, and when they sell it to us, who are a predominant chunk of their customers, we would be paying the cash immediately, right? Can you tell Spencer's that, sir, I'll pay it after 1 month? No, they'll tell you, don't buy the goods, get out of the shop right now, right? So you have to pay the money immediately. So in that case, if you see, obviously the buildup of receivables in case of a company like Spencer's is going to be very less as against the buildup of payables, because they will be getting credit period from their creditors, but they won't be able to pass on the same to the customers because the customers will be paying spot cash. I hope that is very clear, guys. Next, in an entity like Spencer's, so let's look at each of these scenarios, right? Let's say, so this scenario is probably ruled out because Spencer's would not be delaying payment to creditors, because any industry that is in the B2C is more likely to have negative capital. Okay, let's look at this scenario. Let's say Spencer's has good collection ability and lower inventory holding period, which is something to be happy about. Let's take case A, the balance sheet where the fixed assets of 15, where there were fixed assets of 20, out of which 5 was financed from our current liabilities. Is that a good scenario? You really wouldn't say so, because what would happen is, if you look here, at least in case of a manufacturing concern, you can say that the fixed assets would help in production and would have an ability to generate cash flows, and the inventory that is getting produced out of the fixed assets can be sold in the market and you can meet your current liabilities. But you can't say that in case of a concern like Spencer's, because most of their operations are in relation to traded goods, meaning that the components that they manufacture are very, very less. So in that scenario, case A is also a matter of concern, because in Spencer's, because it is mostly a concern which deals with traded goods, they would not have a good chunk of PPE that would help in producing and thereby selling. So it is actually a matter of concern, because the sales would be on, because it is actually a matter of concern. I hope you understood this. But let's say but what would happen is, since a major chunk of Spencer's sales are on immediate cash basis to people like you and me, there wouldn't be a need to sell the fixed assets to meet their current liabilities, because they will be getting cash on a regular basis. They will have a good collection from customers like you and me, due to which they will be able to meet their current liabilities. So even though there is a diversion of short-term funds for long-term purposes, in a B2C concern like Spencer's, it is not a matter of huge concern. So I hope you understood this, guys. Next, case B, similar to the above discussion, would not be a matter of concern, because obviously in case B, as we had said, it more looked like a strategic decision from the management to put the funds in an FD instead of like putting it in an asset. So, and liquidating an FD is obviously easier as against liquidating an asset, as we had discussed. So obviously again, situation B is not a matter of concern, right? So if I have to show you current ratio from Spencer's annual report, you can see that it is less than 1. Basically, what is the formula for current ratio? It's current assets divided by current liabilities. So when your current liabilities are more than your current assets, basically when your denominator is more than your numerator, the ratio is going to be less than 1. Obvious, right? Yes. Look at the ratio for 2024, 0.37. For 2023, it's 0.43. So this is again an evidence that if you're in the B2C sector, the odds of you having a negative working capital are going to be high, because it is inherent in the nature of business and it is also implied. I hope you understood this, guys. Next. Okay. So we saw all of this. Coming to the second part of the video, like how do you deal with this as the auditor? Let's say you're auditing a company and let's say the company has negative working capital. So first you will look at the industry in which the company is engaged in. Like let's say it is a B2C concern, you need to evaluate it in the way we evaluate it. And let's say it is a B2B concern, you need to evaluate it in the way we evaluate it. But more than that, there is a reporting requirement in relation to this. So clause 390 of CARO 2020 asks the auditor to evaluate whether short-term funds have been used for long-term purpose. Some of you might be saying, sir, we need to qualify clause 390 immediately, because in all the cases which we saw, our short-term funds were used for long-term purposes. But what if I told you not necessary? It is not necessary. You won't believe me, right? But let's just read this a bit and let's answer the question, right? So I've taken a snapshot from the guidance note of CARO 2020 and let's start reading from point B, because the earlier point is relating to another subclause in 3.9. So let's ignore that for the time being. Let's read this. So the auditor uses the data contained in the financial statements to ascertain whether the funds raised on short-term basis have been used for long-term purposes. Short-term sources of funds include temporary credit facilities like cash credits, overdrafts, long overdrafts. Sir, did they say trade payables are included in short-term sources of funds? No, sir. Why, sir? Why didn't they say that trade payables are not included in short-term sources of funds when trade payables are actually a short-term source of funds? Guys, you are right. From a business standpoint, definitely a trade payable or a supplier, a trade payable is definitely a short-term source of fund. I definitely agree with you. But CARO recognizes a practical difficulty, because in case of a trade payable, your supplier is giving you goods on credit. Your supplier is not giving you a loan. So it is very difficult to understand as an auditor or from a fund flow standpoint as well as to what have you done from your trade payables financing, like how have you diverted the amount that of your creditors towards your asset side. It is very difficult to track rupee by rupee in case of an arrangement like trade payable, because in a trade payable, your creditor is giving you goods on credit. He is not giving you a loan like a bank, right? I hope you understood this. But in case of a loan, it is very easy to track the amount that is getting spent, because what would happen is when a bank gives you a loan, the amount is directly credited to your account. You know what you're doing with that amount. You know how you're using it, whether you are using it for long-term purposes or whether you're using it for your short-term purposes. It is very easy to understand in that case, right? So that is why Caro has excluded trade payables from the scope of short-term sources, right? I hope you understood this. So from a business standpoint, yes, in all the scenarios we saw, short-term funds are used for long-term purposes. But from an audit standpoint, we need to see what those short-term sources of funds comprise of, whether they comprise of trade payables or whether they comprise of only your loans from banks, or do they comprise of a mix of trade payables and short-term loans. So for that also we have an example. We'll discuss that towards the end in a few minutes. And next they're saying long-term source of funds would include share capital, reserves and surplus, long-term debt securities and long-term loans. It is clarified that current maturities of long-term loans, which are included as short-term borrowings, are to be treated as long-term source of funds. Because what would happen is in your financials, you would classify your current maturities of long-term loans under current, because the amount would be payable in the next 12 months. But Caro recognizes the fact that even though the amount is payable in the next 12 months, this amount actually relates to a long-term loan, which is classified as current because it is payable in the next 12 months. But since it originally relates to a long-term loan, treat this as a long-term source of finance. That is what Caro is telling us to do, and rightfully you should be doing the same. Long-term applications of fund include investment in property, plant, equipment, intangible assets, long-term investments in shares, debentures, and other securities and other assets of similar nature. Repayment of long-term loans and advances or redemption of long-term debts or securities are also long-term applications of funds, right? Yes. Next, the auditor should determine the long-term sources and the long-term application of a funds of a company by using data contained in the financial statements, for which again we have done a video. As I told earlier, you can check the video out. The link of it is in the description. Next, the quantum of long-term funds of a company is not significantly different from the long-term application of funds. It is an indication that the long-term assets of a company are financed from long-term sources. What they are saying is, let's say my long-term source of funds are 100 and my long-term assets of the company are 100, then it means that my long-term source of funds have been fully used for my long-term assets. So there is no possibility for diversion. However, the quantum of long-term funds is significantly less than the long-term application of funds. Let's say my long-term loans are only 80, but let's say my fixed assets are 100. It might be an indication that there is a diversion from short-term sources to the extent of 20. But we cannot conclude that there is a diversion straight away. We need to see where is that 20 coming from. Let's say that 20 is coming from a short-term loan, then it's a matter of concern. But let's say that 20 is coming from a trade payable, then it's not really a matter of concern, because Caro does not look at trade payables as a short-term source of finance due to the practical difficulties involved in looking at it in that way. I hope you understood. Then the difference between figures of long-term funds and long-term assets of the company indicate the extent to which short-term funds have been used to finance long-term assets of the company. As we discussed now, let's say the long-term source of funds are 80 and the long-term application is 100. It means there is a diversion of 20 from my short-term sources of funds. I hope you understood this. Next, coming down. So in the case A, which we saw, let's say the current liability of 20 comprise of trade payables to the extent of 15 and short-term loans to the extent of 5. Okay, let me just go up to the balance sheet and I'll just explain case A so that you're able to just recollect it better. So what they're saying is, in case A, we saw that the fixed assets of 15 to the extent of 10, so to the extent of 10 were financed from share capital. The differential of 5 was financed from our current liabilities. So what we are trying to say here is, the current liability of 20, we are breaking it up into two parts. One, the trade payable component, the other, the short-term loan component. So let's just come down and let's just cover this. So what we are trying to say is, just coming down guys, just a moment. Yeah, so we are saying that this current liability of 20 comprised of trade payables of 15 and short-term loan of 5, which was acquired to use fixed assets. So this could trigger a negative remark under clause 390, because what is happening is, to the extent of 5 from my short-term sources, I am diverting my short-term loan towards it. So this will trigger a negative remark in Caro, where as an auditor I will say that short-term funds to the extent of 5 were used for the application of long-term funds. So what I'll basically say is, short-term sources to the extent of 5 were diverted is what I'm going to conclude in my Caro, which is a negative remark. Next, let's take another scenario. Let's say the entire 20 was with respect to trade payables. So let's say the 20 did not comprise of any short-term loan. Then there is no qualification that is required under Caro, because as I told you earlier, Caro does not recognize trade payables as a short-term source of finance. So the concept of diversion under Caro would not arise. So you would not be required to give a negative remark as an auditor Under Caro, in the second case, where the entire 20 per day, so trade payables. I hope it is very clear, guys. Okay. The final act, as we discussed. How do you answer this in a finance interview question? As in a finance interview, if this is put forth to you as a question. So the first thing you need to ask the interviewer is like, what industry is the entity in? Let's say, is the industry in a B2B industry or in a B2C industry? Let's say the interviewer tells you that it's in a B2B industry. Then you have to tell the interviewer that it is more likely a matter of concern, because in a B2B industry, the chance of negative working capital are relatively lesser as against a B2C industry. But let's say the interviewer tells you that it is a B2C industry, then you have to tell the interviewer that the chances of having a negative working capital are higher in a B2C industry, because it is an industry norm, because the customers are going to pay you spot cash. So it is highly likely, and if it's a conscious business decision, then it's something really good. But let's say you also have to understand from the interviewer about the past year's trend. Let's say the interviewer tells you that in the past years the company had a positive working capital. In the current year the company is suddenly having a negative working capital. Then you have to tell the interviewer, sir, I would first understand from the management whether this was a conscious decision or whether this was a financial mismanagement. If it's a financial mismanagement, it is a matter of concern. If it's a conscious decision, I will understand how the business is strategically planning the same and get comfort over the same. So I hope you got answer to all the three parts which we were about to discuss, guys. And if you found this video insightful, do hit that subscribe button and keep learning, keep growing. Thank you so much for the support, guys. Cheers. We'll meet soon in another video. Thank you. Take care.